means that you're simply living beyond your means. Now, debt is not necessarily bad. If you actually look at the most economists will tell you that the poor are not bankable, so they can't borrow. And the richest are actually the ones who are attractive. So meaning that you can actually use debt to leverage economic prosperity, whether it's from an individualistic perspective. We do have three key main economic agents. Usually you have households, that's just us. Then you have the corporate or the firms. And then you have the public on the other side. So what we're looking at is public. When we say public, we're referring to government. So it could be central government, local government, and other state corporations. Now you notice that for our case, we'll be focusing more on public debt. Now, how does public debt arise? Public debt arises because government spend beyond the revenue that they are collecting. Now, there are usually two forms of revenue which is usually the tax revenue that you pay. It's either in terms of direct revenue or indirect revenue. Indirect revenue could be what you're paying if you consume water, what you're paying on goods and services. That's indirect revenue. Then you can also have non-tax revenue, if you're paying for a passport, if you're paying for, but all that collectively would give you a pool of what we call domestic revenue. Now that pool of domestic revenue is then what would backstop your expenditure. So every year, I believe your ministers of finance come and tell you that we're going to spend this much, but our revenue expected is this much. So when the revenue is not enough to meet your expenditure plans, then you run what we call a budget deficit. Now, when you run a budget deficit, or what we call a fiscal deficit, it means that you have to finance it somehow. Some countries could go down and print money to finance that fiscal deficit, but that is not recommended because then you're pumping a lot of money, which would cause prices to rise. So then you can come back and borrow. Now, two forms of borrowing could be you either come back and borrow from the domestic market. I know here in Kenya they do significant borrowing from the domestic market. So the borrowing from the domestic market, it's an IOU. So government just gives you a paper and you give them money. But the tenor could vary from, there's short term and long term. So that's domestic borrowing. But in most instances, domestic borrowing is expensive because you're borrowing, it's very expensive. If I take an example of where I come from, if government is borrowing from the domestic market, it's paying 10%. So that's quite expensive, at least 10%. So if it's longer term debt, then it's paying higher. Then if you can't meet all your domestic borrowing can't meet your fiscal deficit, then you will turn. Or you could also get grants, by the way, I forgot that you could get grants from, bilateral donors. But that also may not meet you. So then it would mean that you'd have to borrow from the foreign, you'd have to borrow from the external sources. So now that foreign borrowing also comes in two ways. Traditionally, we used to borrow from the multilateral development institutions. Now, what these ones were giving us is what we call concessional borrowing. Now, that form of concessional borrowing was long-term in nature, 50 years. It had a longer-term grace period, and the interest rates were near zero. So they were friendly terms of borrowing. But they also had significant conditionality. So the negotiation for these loans would take time. Now, in recent years, we've seen an emergence of non-concessional borrowing. So it's shorter term tenor, shorter grace period, and near market rate interest rates. So meaning that this is costly. Now, the challenge is with concessional, because when we are looking at debt, debt becomes unbearable if you cannot meet your short-term needs. you start to struggle with what we call liquidity challenges. Then the debt becomes a burden when you become insolvent. So at that point when you become insolvent, you actually are not failing to meet but you also fail, you're basically bankrupt. So now those are the two risks that when you're managing debt, even from an individualistic point of view, you're looking at, are you having any liquidity challenges? Or are you likely to have, debt burden? Eventually, you're basically poor to meet any of your needs. So those are the things that I think we should be looking at. So any budget deficit that you accrue contributes to your public debt. So we have been borrowing for as many years. And every year, if I actually look at African continent, I think we do not have a country that has a budget surplus. A budget surplus would simply mean you're spending less than you're collecting in your domestic revenue. But the estimates that we have looked at, because mainly African countries are either low-income countries, or they also struggle with human development. So they are categorized as, by UNDP, most of them, about 34 African countries, are categorized as low human development category. Now, that would mean that you have huge human development challenges. And in terms of demographic, Africa also has a big population. So meaning that you need to actually invest, you need resources to invest in this human development. In terms of infrastructure, Africa still has the largest infrastructure gaps. So meaning that on the expenditure side, the expenditure needs are enormous. But in terms of tax effort, Africa actually has the least tax effort. So meaning that on one end, you have huge development needs. On the other end, you have a low tax effort. So what it simply means that if you have to meet these needs, you have to borrow. Are we together? And that's what is causing our debt levels to rise. But then what we see is that today, in terms of investment needs, the ones that I've seen costed by UNEC and other partners, is that Africa's additional financing is in excess of 500, that's additional financing, is in excess of 500 billion. And currently, if you looked at the concept note that was given to you by AFRODAD, the current revenue that we collect is about 457 or so. So meaning that our additional needs over and beyond the revenue are higher than the current revenue that we collect. So the needs are actually big. So then how do you ensure that you meet these needs without creating the risks that we've seen of liquidity so what we see, normally what causes public debt to rise is one, if you have a war, then you have emergency expenditure. You see, we've seen like with the destruction in Ukraine, if expenditure is likely to rise. So if Ukraine coming from a war, it doesn't have, the economic potential has been hampered, so the revenue will be small. So in that, it's acceptable to actually increase what we saw with crises that we've seen, whether it's the 2008 financial crisis or even the COVID crisis. Now, what COVID crisis brought is that we had lockdowns in many of our economies. We had economic activity slump. And revenue depends on the economic activity that you have. So meaning that revenue was declining. But at the same point, we had challenges of livelihood, we had challenges of life. So it means that government had to increase because we had near bankruptcy of households and farms. So meaning that when the economy, these two are struggling, then government as a key stakeholder is what will protect the economies from failing. So in that, it is recommended that you can spend temporarily increase your expenditure in order to rebuild and rebuffer these economies. So those are some of the causes that you can have rising fiscal deficits. What have we seen in terms of the trend so we've had the history of where we've had, debt relief and debt forgiveness under the highly indebted poor country and the MDRI. What we've seen here, if you look at where the curve is going down, that is where we're having a debt relief. But what we see is that in recent years, we've actually gone back to pre-debt relief levels. You see that the curve is actually fast rising. Now, the lower curve, which is in green, is showing the sub-Saharan Africa. So showing that sub-Saharan Africa, in the medium term, after 2020, it should have its debt coming down. But then the big question, I think, which we should be asking, even as media, are we likely to see that coming down? Because we've seen all these projections time and again, whereby you should adjust down your debt, but you have huge demands. So the likelihood that you will see that green curve coming down is also not likely possible. And I think that's where we need to be very vigilant and keep our eyes on whether debt will actually come down in sub-Saharan Africa in the next 5 years, if we are to remain in a debt-sustainable path. But one important thing that we should see, and there are many schools of thought in economics that say today's debt is tomorrow's taxation, because taxation is your fundamental basket of paying off this debt. So meaning that if you're not going to pay your mistakes today, if you do not invest prudently, are going to be borne by our children in terms of taxation. So what we see here is that debt, the red curve, has been rising faster than the rate at which revenue is rising. So again, it shows that if we keep this trend, we are not likely to actually sustainably meet, because debt is rising at a much, much faster rate than. Now, in terms of debt sustainability, where you see red, and this was actually before pre-COVID, so some of these have been adjusted. But where you see red, those are the ones that are, in a debt burden. So the risks of meeting their fiscal needs are actually quite high. Then what we show also on the other side is that these are countries on the right. These are countries that benefited from a debt relief, but they're already having high debt stress levels. And within the concept note we've highlighted, I think they've highlighted countries that are already in debt stress or likely to be in debt stress. But here they're always looking at what is your likelihood to meet your needs. Are we together? What is the likelihood? So countries that are in debt stress are at the risk of defaulting. Today the debate is that Russia will default on its debt because they have been cut off the financial system. They don't have the dollars, but they have managed to meet, even because of the reserves they have, managed to meet some of their short-term obligations. But in the medium term, you see that the sovereign ratings are now starting to come down on Russia because the likelihood to default is quite high. So even when you're in these countries, and when these risks manifest, because what we saw with the Greece, or even when we had the Euro debt crisis, Greece had also reached high levels of debt burden. So meaning that it had immediate expenditure needs, but it was not collecting enough revenue. But it's coming back to the market, and the market is telling them, you're too indebted, we can't lend to you. The multilateral development partners are saying, if we have to lend to you, we have to lend to you when you have restructured. You're allowing pensioners to go at 50. That means an immediate fiscal need. Then your revenue is not enough. You have ships that are not being taxed. So you need to do all these reforms that you bring in revenue, and then the creditors will be able to look at you again and say you're bankable. And remember, Greece could not print its own money, no longer had that power because it was part of the Eurozone. So it was depending on the euro, which was issued by the European Central Bank. So when these risks manifest, you'll either go into printing money, but that has significant adverse effects. Your money will lose value, and you'll cause, you'll have your money, you have 1 million shillings just buying your bread. So these are the things that you want to also always And what has COVID, I had explained a bit so it gives us a bit of a trilemma in the sense that we had increased spending, we had reduced revenue, but at the same time, from what we've seen in the previous slide, is that the risks of debt have gone up. So what do we do in such a situation? Now, of course, the debate was that in the short term, you need to survive a war, and then you reconstruct. But then for how long can you do this? I think that's the question that is being asked. There's this whole dilemma that you need to spend more, but you have less tax effort, but also at the same time, you need to reduce your debt. Now, if you've been following some of the advocates like Jeff Sachs, they've been advocating, saying these are poor economies. You can't ask them to start living within their means. So we should allow them some debt expansion and be able to restructure to ensure that they are able to meet some of their needs. But then the debate is who's willing, and I think Jason touched on it, is that some of the private creditors are not willing to come on the table to have that discussion. So again, but we'll look at, and I think in this case, Jason touched on some of the initiatives that, I gave you the additional spending. If you look at the additional spending needs, it was above 500. But what we've been able to get as African economies from this debt service suspension initiative is about 10 billion over the 2 years. So it's not sizable, a lot of money. When he spoke about the special drawing rights, it was also not much. It was $33 billion. So it is just, again, small amounts it gives you a relief. And what this was actually trying to address, if you think about it, it was trying to address liquidity challenges. Because if you are able to pay this money, you are not going to be able, and the conditionality here was that the savings you have here should be invested in health and COVID-related measures. So that was the kind of conditionality around, and maybe to understand better, I think many times I've even had journalists call me in Uganda, they've had to ask what are special drawing rights. So I put a video here. Maybe I could ask the one who's presenting to click on the link at the bottom to allow us to view shortly and understand what the special drawing rights are from the IMF. Could you help me play the link So in terms of special drawing rights, maybe let me touch on it briefly. These are so you're allocated special drawing rights by the IMF based on the shares you have with IMF, but which are computed based on your relative economic power in the world. So Africa's economic power, if you look at Africa as a whole, our contribution, say, there are two main economic flows, trade and maybe your global output. Africa's contribution to global trade is 2 to 3%. The same thing with Africa's share of economic output or GDP to the global GDP is just 2 to 3%. So in terms of allocation, we're also likely to get the same amount of allocations. Now, we are given allocations. These allocations it's not tangible currency, but it can be exchanged for the agreed reserve currencies. So once you draw down if you want to use the money, you will draw down your allocation. But remember what they do is that if you have an allocation and you draw it down, then you start paying interest to the IMF. So there's an interest that accrues when you utilize the funds. Are we together? So countries that have, good foreign exchange reserves can actually buy part of your allocation. And that's how you get resources, the conversion of those resources to use them. But what we are saying that even when we are going to use them, in terms of the absolute amounts that we collect, it is still a small amount of money. And that's why I think the debate is that we should be getting to say that these are poor countries, we wait into the discussion that they should be getting higher, not just using the economic power to allocate these special drawing rights. So what should we look at country level? What should be the issues that we should look at? One of the things that we should look at is in terms of fiscal policies, is the budget, we spend every year. And we should be looking at, there are three things that we should look at. One, how you allocate the money. Okay, basically, if you're going to spend, how are you going to finance the deficit? Because how you finance the deficit relative to your already debt levels matters. That's why we say the fiscal discipline. The second is in terms of allocative efficiency. Allocative efficiency means that if you're spending, if you're allocating these resources, are they going to where they should be, yielding the best return? Now, when the resources are also allocated, then you look at operational efficiency, how the resources then are utilized. So that's in terms of the prudent fiscal policy, that you should be looking at it from the three dimensions. You should not overly spend beyond your means. You should also not, what we've seen in many other countries is that when you have wide spending, you don't have a lot of foreign borrowing, then you go for domestic borrowing. Now, when you go for domestic borrowing, you're competing with the private sector. So when you're competing with the private sector, governments will tend, banks now in many developing economies, like in Africa, banks have gone to lending to government as opposed to lending to the private sector. Because the private sector potential is also a bit constrained. The bankable private sector, a lot of it is informal, so banks now choose to go to lending to government. And that means that you're crowding out the private sector, who are the creators of the bulk of employment. Who should be the thrust, who are the ones you should be taxing eventually to actually repay the debt. So those are some of the things that we should be looking at. We should understand how our budget is financed. We should understand whether the budget will create debt risks. So that's the prudent fiscal. The other aspect that we do not normally take on, particularly when we are discussing, is in terms of government's obligations to the suppliers, whether it's from us or from, now these are domestic areas. In many of these African economies, you see government not paying timely their obligation, and this creates a rise in domestic areas. In my country, it's about 3% of GDP. And these numbers are not factored into, the debt sustainability frameworks. But eventually, it's a call on revenue as well. So meaning that we must pay attention on domestic area strategies we have in our economies. The other is in terms of, I keep telling people that governments are borrowers, but they're also lenders. Every time we guarantee, we are in principle saying we have lent. Because if that guarantee does not materialize, then it means that it is us, it is the governments that will take on the liability. Now, for most of the public-private partnerships, so for example, most of the road tolls that I've seen in Africa, the governments will take the demand risk liability. To say that if the toll revenues do not materialize into the revenue to meet the availability payments to the private sector, then government would have to pay those top-up payments. And in most instances, we've seen actually where the private sector comes up and says, but this revenue will never materialize. So government eventually buys back the project. So it goes back into traditional. Buying back means that now you get debt and then you buy back the project. So the benefits of a PPP have not necessarily been accrued. And PPPs, this is public-private partnership. Essentially, you want to build a road, you bring in private sector, who brings in their equity into the project, but equity is more expensive than debt. But because they bring in efficiency, you tend, and also, instead of you borrowing today, the private sector is not asking for that resource immediately. So what you should have borrowed to invest in hard infrastructure is now being met by someone else. So you pay in the longer term. But if the demand risk materializes, then it comes back to government. So we must also pay critical eye to the private, and I think it's important also for the media to say, let's not just look at traditional debt, but what are the other aspects that we should look at? Then the whole aspect of transparency, debt information, how it is published. One particular, for me, initiative that I like is the extractive in the Extractive Industry Transparency Initiative, whereby companies that are involved into natural resource extraction publish what they pay government, and government publishes what they receive. So at the end, you're able to reconcile. Now, I've seen countries, I know like when Nigeria first signed up to the extractive industry, the EITI, it was able to to identify that what the companies had paid and what government had received, there was a difference of $8 billion. So then there had to be reconciliation, and there was gradual recovery of some of the money. So it's some of this initiative that, you know, and I think Jason kept touching on it, on these non-disclosure clauses on some of the agreements that we sign. We should advocate for as much information on these agreements because we are key stakeholders of this debt. So we also must understand some of these, and I think we can have a call on, you know, the IMF and the World Bank on some of the tools they use and they run programs where they simply run programs where they support government to do these diagnostic studies on debt. But I think what is also key is that as key stakeholders in this process, we can be involved, we can understand some of these tools, and then be able to ask the right questions. Because these tools are only necessary, they are not sufficient. So there are certainly things that we can particularly the political risk. And I think the media is good at analyzing the political risk in this framework. Because the economists will commit that we will reduce debt in order to live. But is the political environment supportive to actually backstop such? And I've seen in many instances, I've seen deviation from the agreed path that is, you know, and that's how countries just move from, you know, you start from low debt risk, you go to moderate, you go to high risk, then you go to debt burden. If you try to critically analyze that path, you tend to see political dimensions. During election years, you see a lot of supplementary spending without of the financing stream. And these are some of these political risks that you see. So again, I keep saying that debt thresholds are only necessary. If we look at most developed economies, they have higher debt levels. Today, the most indebted countries in the world is US, China, Japan, in that order. They are the largest economies in the world. But what are some of those things that matter? And again, I refer to the fact that the poor are not bankable. So the issue is that, you know, in most of these developed economies, interest rates are low, meaning that the interest rate cost is actually relatively low. Now, we've seen in Africa, we've seen, like, I can even give an example of Uganda. Uganda is now a moderate debt risk, but its interest payments are already, as a share of GDP or share of or revenue, are already in the levels of a high debt risk burden economy. 1 in 5 of the Ugandan shilling that is collected goes to paying back debt. In only interest payments, by the way, not paying the principal. So again, it means that it refers to the fact that the debt composition, where you're borrowing from, you're now going for more non-concessional and shorter-term borrowing. We've seen many economies in Africa whereby they call them domestic refinancing. So what they do is that every year you have debt that is due to be paid to the private sector, to be paid to the domestic economy. But because you don't have money, you issue the same amount to repay. So it's kind of a Ponzi game. Are we together? But how can you run it, you know, continuously? Because the private sector at some point will price you and say, you're too risky. And that's when you struggle with, you know. So these risks can easily materialize despite having these debt thresholds and debt sustainability frameworks in place. So that the interest rate structure in most of the developing economies are double digits. So, and also, like I mentioned, we've seen a gradual movement to non-concessional, even when it comes to. But one other important factor that even when we borrow from external markets, is an exchange rate risk that is likely to materialize. And we've seen in 2015, when we had many African currencies depreciate, that's when we saw debt levels significantly rising. A case in point was Nigeria at that point, because they were dependent on commodities like oil revenue. So when the potential oil revenue inflows didn't come, it means that they had huge foreign currency needs, but the foreign currency wasn't coming through. So their currency depreciated rapidly. Because they had obligation on external currency, their obligations of debt service rose rapidly. Zambia was the same thing, copper, 2015. Zambia rose from, it's actually being downgraded into a debt-burdened economy was around the same time. It was a currency issue. So again, these are important to look into. Another thing is that today's debt is tomorrow's revenue. So if you have a highly informal sector, it is hard to tax. Now what we see is that in most economies, in developed economies, you have debt to the formal sector that is relatively low. When you come to African economies, when you look at debt to formal sector, then you see numbers jumping extremely to high levels. The other thing is, of course, is that we have many, in Africa, we do not have proper reconciliation of public assets. Now, if we had proper reconciliation of public assets, then we would know that we have performing assets. If, say, you have Ethiopian Airways, it's profitable, it will not be a call on your needs, on your fiscal. But when you have a lot of state corporations, without proper reconciliation of even the assets and how they are performing and what return, then it's a problem. And I think that's why under the structure adjustment policy that was adopted in the late 1980s, it was for these non-performing privatized. So that's why we had a drive to ensure that when you privatize, then take away the needs on a call on the budget. But that also did not necessarily work very well. But it is important to look at your debt to the performing assets, because then you identify potential revenues to pay. Then, of course, what is also key is in terms of the institutional debt holders, they are easy to restructure. But I think something I want to also raise that maybe we should be asking ourselves. We've been borrowing, we've had a debt relief, we've had a debt service suspension, but to what end are we going to be in this whole cycle? It means that you're willing to always live beyond your means, but the risk is borne by someone else. So there's also a risk in the long term that someone else may not want to bear the risk. Are we together? It's simply like, if you take insurance, then you can drive your car when you're drunk. You see, so in the event that then you will have insurance will bear the cost. But that cannot be sustainably. At some point, there's going to be evidence that you are drunk and there will be no payment. Are we together? So the other issue that I think we usually talk about is that it's the interest rate vis-a-vis the growth. So when your interest rate is higher than your growth, in the longer term, it is hard for you to pay that debt. So take an example, your annual income grows by 5%, but you've been borrowing at 16% or 20%. It becomes hard because your annual income source is your source of paying off this debt. So eventually it becomes hard to repay and still meet the other needs. Then one critical factor that is what we see with the debt productivity. $1 borrowed, what is the expected return? Seen in the US where you have, $1 borrowed and you have $4 return. You have had cases in Africa where you have $1 borrowed and you're getting only 70% return of the dollar. So again, the productivity is very important, and that's why we are saying we have increased and one other issue I think that we must pay and understand is the cycle of debt, the debt approval process. Is there a checklist in place at country level? What should be the process of borrowing? Who should be approving? We've had cases, and we've seen cases whereby rising what they call commitment fees. When you borrow that money, you've signed a loan agreement. That money does not come all at a go in your economy. It simply means that you have to prepare preparedness reports to the borrower on how to use the money. So what we've seen is that most countries are actually not using money. So we've seen rising share of commitment fees paid with money that has already been approved. So it's not released. Any unreleased money accrues a fee, a cost, and that's what we call commitment fees. So again, we must pay attention to some of these. We are just simply borrowing because every sector is trying to present a project. So and we've seen this becoming up time and again. What we've seen is that debt thresholds could actually matter. At the end here, see that countries that, when countries go beyond, like in developed economies, when they go beyond 90% of public debt account for 90% of GDP, we tend to see growth slowing down. The same thing with emerging economies, the thresholds are much lower, that when they go beyond 70%, you tend to see growth starting to come down. Even for developing economies, the thresholds are even much lower. So again, I think as we look into these, it is important to factor into that we need to have transparent policies. We must internalize the data and understand it. And I believe in all this, the media has a role to play in terms of understanding the public debt, understanding the risks, being independent actors, and being independent actors in the sense that the media covers all legislative processes. There's no loan, external loan particularly, that goes through without being approved by Parliament. So in the entire cycle, the media has an oversight role to play and ensure that the right information is coming out, particularly either in playing a challenge function or educating the citizens in terms of what. Then the discussions on debt restructuring for fair negotiations, I think this is also very critical. Fostering collaborations between national, regional, and international media organizations to ensure that a key role can be played in some of these renegotiations. And of course, fostering a transparency is also another issue that I think the media can play.